Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 28th of October. I'm Daniel Lam, your host for the podcast. Yesterday, we spoke about how the less hot than expected US CPI paves the way for another 25 basis point Fed rate cut on this coming Thursday. We concluded that investors should be adding US equities, especially the AI-related stocks, on dips. Fed cuts, against still elevated inflation, will push real rates lower further and put pressure on the US dollar. And this will support another very important asset class, gold. We are raising our 3-month and 12-month gold forecast to 4,300 and 4,500 respectively. This is a great opportunity for investors with low allocation to gold and gold mining equities to be averaging in and adding to both. Our balanced strategy has a 7% allocation to gold. We stay structurally bullish given geopolitical uncertainty and concerns about fiscal policy, the Fed's independence, and de-dollarization. These are all positive factors for gold. Now, the structural drivers remain intact even after the positioning-led profit-taking that we've been seeing recently. The freezing of Russian assets by the US and EU after the war in Ukraine started in early 2022 was the main structural trigger for gold's rally. Persistently strong gold demand from EM central banks since that decision provides strong foundations for this rally. The aggressive trade, fiscal, and foreign policies in Trump 2.0 added a new structural tailwind. We're expecting a truce between the US and China trade tension in the meeting on the 30th of October. But like we discussed in an earlier podcast before, this will be a truce out of convenience, and the trade tensions will not be going away. Gold is benefiting from investors' confidence in the hard asset compared to the fiat currencies. The expansionary US budget for the new fiscal year has added to concerns about the US debt sustainability, with fiscal deficit already running around 6% of GDP, while growth remains above trend. Moreover, there are questions about the Fed's independence. For example, the persistent pressure on Fed Chair Powell to cut rates despite inflation being above target, potentially accelerating gold's rally. All these lead to rising investor demand. Gold remains underowned amongst institutional and retail investors. Now, although the gold-backed ETF holdings have risen this year, they remain well below their 2022 peaks, suggesting further room for investor inflows and ultimately higher gold prices. There are risks to this rally, for example, investors turning more price-sensitive, and the US growth remaining above trend and limiting the room for the Fed to be cutting rates. But we believe, on balance, the pro-gold factors are more, quote-unquote, in play versus the risk factors. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.